What's going on, investors? My name's Emmanuel and welcome to my channel. In my previous top 3 growth stocks video, I explained Peter Lynch's criteria for identifying fast growers or growth stocks. And after applying these criteria to my stock screener, I managed to identify Square, Adobe and Amazon as my top 3 picks. Since I first published that video on the 5th of June, Square is now up roughly 20%, Adobe is up 15%, and Amazon is up 11%. In comparison to the Dow Jones, which is down 5%, the Nasdaq and the S&P are down 3.5% respectively. Now, for full disclosure, I did pick up shares of Square on the 5th of June at around $87 a share, but I made the schoolboy error of chasing the stock as it went up, and my average cost price now for Square is $89 a share, which effectively means my position is currently up just over 15%. This was my first time using Peter Lynch's criteria for identifying growth stocks, and so far, I have to say, it's rewarded me pretty well in a relatively short space of time. So naturally, I reran the search criteria once again on my stock screener, and I have managed to identify 3 more growth stocks that hit this criteria. But before we jump into the analysis of these 3 growth stocks, I would like to remind you once again of the 7 criterias that's needed to be met by these stocks to qualify as a growth stock. The first criteria is a revenue growth rate of 20% or more year on year. The second criteria is the company has to have positive earnings growth. The third criteria is a strong balance sheet, which pretty much entails a higher current asset versus current liabilities, little to no debt, and an increasing stockholder equity. And the fourth criteria is a positive free cash flow. The fifth criteria is room for growth and the company's expansion plans. The sixth criteria is the stock has to have duplicated itself in multiple cities or in multiple countries. And the seventh criteria is the stock's products or services has to be reusable. Now you know the criteria, let's jump straight into the analysis. Alright guys, so my first growth stock that I have for you today is Etsy, ticker symbol ETSY. And if you're familiar with my channel, I like to do a quick profile of the company so we have a greater understanding before we start looking into the numbers, okay? So what's the story of Etsy? So they're an online marketplace, for buyers and sellers. However, their USP is that the sellers focus on more handmade, vintage items and craft type items. So whereas Amazon does the general majority, you can buy anything of Amazon. With Etsy, they have more of a niche, so that's definitely their USP. So they're a consumer to consumer e-commerce marketplace, okay? So next question is, how do they generate their revenue? So again, they generate their revenue through transaction fees and marketing services via Etsy Pay. So when a seller makes a transaction or sells something, pretty much Etsy take a minimum of 5% of the sale value. So that's how they cash in. They also generate revenue from Etsy ads as well as promoted listing charges. And pretty much what that means is if you're a seller on Etsy and you wanted your product to rank higher more than the competition, then you pretty much have to pay Etsy a little something and they promote your listing a bit higher. Alright, and they also generate revenue through Etsy shipping labels, which is again similar to like your drop shipping that you can get on other platforms as well. So their main competitors, of course, is eBay, Amazon, Shopify. I see these are the main threat. However, Etsy do have their own type of niche, so you won't go to Etsy for your general supplies. Obviously, you go to Amazon or whatnot. But if you wanted something a bit funky, something a bit vintage, you're more likely to go to Etsy. Okay. So the risks I find with Etsy is, the current opportunity that they're capitalizing on may not last. So what I mean by that, Etsy has had a huge surge in revenue because their sellers have been creating funky face masks, which I will show you in the annual report to give a bit more detail. And another risk that I found is although they have a niche, their moat I don't think is wide enough for it to have a durable competitive advantage. These are just minor risks in my opinion, but still risks nonetheless. So the first criteria, guys, is does Etsy have a revenue growth rate of 20% or more year on year? Now on Seeking Alpha for Etsy, and once you're on the page, all you have to do is click on growth. And once you're on growth, you can see here their revenue growth year on year has been sitting at 34.5 0%. So it more than ticks our first criteria. Okay, so the second criteria is, does the company have a positive earning growth? And Etsy definitely has. We'll go to macro trends for that. All right, guys, so we're now on macro trends, and we're looking at their income statement to have a look. And you scroll down to net income. And then if you look at that, you can see with Etsy, they've had an increase in their earnings from 2018 2019. They've also been losing money since 2015. However, as you can see, that's decreased, and they turned a profit in 2017. Okay, and now they've actually made a positive earnings growth since the last year. And as of the first quarter of this year, that's also improved. So I expect Etsy's earnings to continue going up. So I would give it a yes for the second criteria. Third criteria is a strong balance sheet. Okay, and for that I go to Yahoo Finance. Okay, guys, so we're now on Yahoo Finance, and all you have to do is click on statistics once you're on the home page. Then you scroll down to their balance sheet, and if you have a look at Etsy's cash position, they have 803 million in cash to their debt, which is 853 million. So as you can see here, they do have a little bit of debt, about 50 million in debt. So I would say that's a very little debt in comparison to their competitors. And also, guys, if you look at their current ratio here, it's 5.71, which is incredible. And if you're not aware, guys, a current ratio is pretty much your total current assets divided by your total current liability. So as you can see here, the total current assets for Etsy is 921 million. So their total current liabilities, which is 188 million. So they have more. So they have more than enough assets to fulfill their financial obligations within the next 12 months. Lastly, guys, taking a look at their stockholder equity, as you can see, year on year, that's gone up, which is a great indicator that their total assets are growing faster than their total liabilities. So that's a check from me. Fourth criteria, guys, positive free cash flow, and Etsy does. Again, I just go to Yahoo Finance for that information. Guys, so we're now on Etsy's cash flow statement on Yahoo Finance. You scroll all the way down. Their free cash flow is positive, and it has grown significantly year on year. Okay, guys, so the fifth criteria is, do they have room for growth, and what are their current expansion plans? So I had a look at their recent quarter reports, and they did mention more about TV campaigns and awareness. So I'm going to bring up their recent quarterly report now. As you can see here, guys, for their first quarter of 2020, they pretty much have said April was extraordinary. And that's pretty much due to, look at their mask sales, 135 million for mask sales. Now, if you think about it, their total cash was what, about 900 million? So for their first quarter of 2020, that's how much they generated from mask sales. If you have a look at the next slide on their annual report, you can see their mask sales volume had a massive spike in April. But also one thing to note is that in New York now, they've mandated face coverings. Also in London, they've mandated face mask usage, especially when traveling. So that's only going to further boost the sales for Etsy. But in terms of the criteria and their expansion plans, as you can see here now, they've got new TV campaigns, and they also want to improve their social media presence. Management have also mentioned that they want to create more engaging CRM tools as well, and that would also help with customer retention. So as you can see here, guys, the management have also mentioned that they've pivoted their brand strategy. So they're really pushing for this expansion. The sixth criteria is, has the stock duplicated itself in different cities or countries? And to check that, I just went on the company profile on Seeking Alpha. And as you can see here on Seeking Alpha, it says Etsy pretty much allows sellers in the US, Canada, the United Kingdom, and Australia. And of course, you know, in UK, we love Etsy, in the US as well. So definitely they have definitely duplicated themselves in multiple countries. The seventh criteria is the stock's product or service has to be reusable. And as you can see here, I found on the annual report that 32% of their sales were repurchases, pretty much, so from their recent quarter. So that's an indication that people are going back and reusing Etsy. Guys, so my second company is Take-Two Interactive Software, ticker symbol TTWO. And pretty much their story here is that they develop, publish, and market interactive entertainment solutions for consumers worldwide, which pretty much they just create games. All right, like they just made it sound really fancy in their report, but they just create games. And some of their popular games is NBA 2K series. You know, they got the WWE as well games. They got Grand Theft Auto, which is a massive title. They have Max Payne, Midnight Club, Red Dead Redemption, and many, many more. Okay, but Grand Theft Auto and NBA 2K series is a game that I've got some experience with when I was much younger. So how do they generate their revenue? Of course, they generate their revenue through the sales of all their game titles, and also in-game purchases as well, and upgrades, and also through sales of merchandise, etc. The main competitors is Electronic Arts, which is EA, and Activision. So Activision make Call of Duty, Modern Warfare. But to be fair, EA does have their own NBA game, but it doesn't really do as well as the NBA 2K series from Take-Two Interactive Software. So their risks, which was mentioned in their annual reports on page 7, they're overly dependent on a few titles for majority of their revenue. So of course, I'm going to take you to their annual report shortly. They've also mentioned one of their risks that they're currently facing at the moment is a delay in productivity with game release dates. So again, guys, we're going to put it through the paces. Do they hit the criteria? So yes, but let's go to the first criteria again, revenue. What's their revenue saying? So as you can see here, guys, their quarterly revenue growth is sitting at 41.10%. So that's definitely a tick for the first criteria. Second criteria is, does it have positive earnings growth? So again, you can just go to Yahoo Finance for this, and as you can see, their quarterly earnings growth is at 115.90%. So that's a definite tick from me. Third criteria, a strong balance sheet. Again, guys, just use Yahoo Finance. All the information is on there. So again, looking at their balance sheet, they have 2 billion in cash and only 177 million in debt. That is unbelievable. That's crazy. So they definitely pretty much have no debt as a company, which is incredible. And also, just the cherry on top, they have a 1.71 current ratio, which is incredible. The next one is, do they have a positive cash flow? Again, guys, on Yahoo Finance, if you have a look at their cash flow, it is positive, although it has dropped. It actually has dropped since 2018, but it still has a positive free cash flow. The fifth criteria, guys, is what are their expansion plans? And on page 3 of the annual report, which I'll take you to now, they mention about their expansion into mobile gaming. So as you can see here, guys, from their annual report, they have actually made an acquisition of Social Point, and that will enable them to expand their presence into free-to-play mobile market. So if they can capture the mobile market like they have captured on the consoles and PC, that's going to further boost revenue, because then they can start introducing advertising from the free-to-play mobile market. I think there's a lot of positive stuff coming for Take-Two Interactive. Next criteria is, as the stock duplicated itself in different cities and countries? Absolutely. I'm just going to give that a yes. You know, we love NBA 2K series in the UK. We also do play Grand Theft Auto. Grand Theft Auto is everywhere, so I'm not going to waste any more time on that. Also, the seventh criteria is the stock's product or service reusable. Of course, everyone keeps on playing those games. Grand Theft Auto was not going anywhere anytime soon, and people just love Grand Theft Auto. Okay, guys, so my third and final company is Paycom Software Inc., ticker symbol PAYC. And they're pretty much a cloud-based software that enables employees to manage their own HR data through Paycom's employee service tool. Okay, so they're pretty much wiping out HR teams and businesses, making it online, and giving their responsibility to the employees to input their own HR data. Okay, so how do they generate their revenue? So employers and businesses of all sizes pretty much pay for Paycom to install and set up their software. Okay, and then they also charge reoccurring fees. So for example, for form fillings, payroll checks, and reports, these also incur further fees, which generates revenue for Paycom. They further push revenue by creating additional applications and features to the software. So again, upgrades and whatnot, they're going to have to obviously charge. So their main competitors, guys, in the UK especially, you have a company called Sage and QuickBooks. I'm not necessarily sure in America, but when I did have a look, there are multiple companies in America that actually do pretty much similar things to what PAYC does. So they do have quite a lot of competition. And the main risk, in my opinion, guys, is I think they have a zero moat. You know, no competitive advantages from my research. What they do, many companies also do. So they can only beat out competition on price, which obviously will then affect their operating margins and profit margins. But they do hit the criteria, guys. You know, they do have a revenue growth rate of 20% or more. And again, we're just going to go to Seeking Alpha for that. As you can see here, guys, Paycom's revenue growth rate is sitting at 27.39%. Also, the second criteria is positive earnings growth. So we just can take a look at macro trends. All right, guys, so look at that. That's a beautiful, beautiful net income growth from PAYC. So again, they do hit that criteria. You know, even though I don't think they have a strong moat, they are profitable and they are growing year on year. Look at that. Criteria again, guys, strong balance sheet. Again, just go to Yahoo Finance for that information. So looking at their cash position, they have a total cash position of 181 million to their total debt, which is 54.39 million. So again, this is a company that has zero debt really. They've got more than enough cash to cover their debt. And also they have a current ratio of 1.10. So again, their current assets are much more than their current liabilities. And while we're on Yahoo Finance, let's quickly take a look at their stockholder equity. And as you can see, that's grown year on year. Again, an indication that their assets are growing faster than their liabilities. And while we're on here, let's take a look at their cash flow. Free cash flow position has grown year on year and it is positive. So they have hit criteria 3 and criteria 4. Now, the fifth criteria is room for growth and expansion. And this is a segment I took from their annual report. So management are planning to develop new software and payroll applications, which they believe will boost client satisfaction and client retention. They also plan to expand their presence in the metropolitan cities that they already have existing offices in, and they also do plan to open up sales offices in new metropolitan cities. So they definitely do have some expansion plans in the works. Have they duplicated themselves in different cities or countries? I'm not sure about countries, but they are in multiple cities within the US, and again, it is a service that is reusable by employees. Guys, I hope you enjoyed the analysis of these 3 growth stocks. Now you know the criteria for determining a fast grower using Peter Lynch's method. Apply this method in your own search for stocks. And if you do find any other stock that meets this criteria, then please suggest them in the comments section below and let's have a discussion about it. And let's get the conversation started. Also, guys, if you want to join a community of generational wealth builders, then I've created a Facebook community to which the link is in the description below. Lastly, guys, if you found this video valuable, then please hit the like button as it really helps my channel grow. And if you want to see more from me, then please hit the subscribe button and also turn on the notification bell. Thank you so much for watching, guys, and I'll see you in my next video. Take care. Peace.